Yesterday was panic. Today was a rescue mission with some kind of FOMO as well. If you're watching the markets, you saw a massive gap up, a dump, and then a sudden reversal. It feels like a casino because right now the house is intervening to keep the game going. But here is the irony. AI is actually popping the AI bubble. Investors have used AI tools to dig through earnings report, and what they found, from hidden red flags in Nvidia's filing to the truth about OpenAI's deal, has terrified smart money. Today, I'm going to walk you through the 4-day timeline of how this narrative unraveled, why the Fed just panic flipped on rates, and what this means for your portfolio right now. So let's start with this headline. As you probably remember from the 2008 crisis, credit default swaps was what Michael Burry took against the banks to bet against the real estate because he saw the crash coming. And right now, because of all the debt that the AI companies are taking on, they're actually more risky than some of the banks before the 2000 crisis. That's pretty bad. This is the credit swap for Oracle. Remember how Oracle was top of the world like a month and a half ago, and they had a plus 40% in one day? Well, since then, insurance against their bankruptcy has more than doubled. And so this is pretty scary when you think about it, because it's supposed to be a very strong company. Another thing that was kind of under the radar, but might completely change the game for the AI bubble, is Google. Gemini 3, their new AI LLM model. And the main thing that most people didn't realize, it's the best in terms of performance and cost. And it was trained using 0 NVIDIA GPUs. They used in-house TPUs, which is basically between like a CPU and a GPU, and it's really good for AI specific stuff. And they were able to drastically reduce the cost. And it's also the main thing, not use NVIDIA GPUs, because all the other players, when they realize this, either they will start using TPUs or they might go bankrupt, and Google is going to take, the biggest share of the pie, which is probably why Warren Buffett finally pulled the trigger on Google, because he realized that Google is going to be the winner of the AI race, likely. So something that was already adding to the Nvidia earnings was not looking good for Nvidia and the whole AI bubble. This is also scary when you think about it. This chart shows you that since 2006, the fund managers have never believed that companies were investing too much. And so for them to flip completely and say, you're investing too much, it really shows you how the whole narrative about AI is completely reversing. It used to be, like what Meta said a few years ago, we just need to invest because we can't miss the train. They couldn't name a single reason why $1 invested in AI was actually resulting in more than $1 in revenue. But now, the cracks are actually so obvious to most people that fund managers are actually selling their equities. Another thing that was really kind of funny in the past few weeks is that I told you every time there's bad news about AI, they would come up with a new deal, a new announcement. And I was always skeptical of it because first, they always invest between themselves. So it's like, oh, I invest in you, but if you buy from me, like, this doesn't look good. But then Nvidia, which is supposed to be this, huge company that has a ton of cash and doesn't have any issues with cash and has unlimited demand ahead of it, they make a deal with OpenAI, and yet it's not a real deal. It's a potential deal that maybe they'll do, but they don't have any legal requirement to actually give the money to OpenAI. So OpenAI could actually be bankrupt 6 months from now, because everything I've seen in the past few months and week is leading to them being weaker and weaker, running on fume, running out of cash, pledging money they don't have. And even companies that are supposed to be investing in them to prop the bubble are saying, actually, we might not do the full thing. So that's pretty bad. And that was all before the earnings. Also, something worth mentioning, because think about the stock market and the AI bubble, yet November so far has been the worst since 2008. So that tells you something about how the market can flip on a dime. And so we get to the day of the earnings, something that I haven't seen before. Basically, the CEO of a really big company about to release the earnings, and the president of one of the most powerful country, patting each other on the back. And it doesn't look good. Like, if it was real, it wouldn't do this. And just as the earnings was released, of course, there was another message saying how, it's going to be awesome and everything. Like, if it was true, there would be no need for this. So this has nothing to do with politics. It's all about, the narrative and the reality. And here was another example where it was pointed out that the language that Nvidia has been using is basically like a used car salesman. They are just overhyping this thing. And the last time actually we saw things like this was during the dot-com bubble. So I won't read everything here because I want to keep the video short, but you can pause and read. But basically, what Nvidia is using in language is basically what Cisco and Nortel and other companies were using in the 2000s, just before the bubble collapsed. And so when I was talking about AI, about to pop AI bubble, usually people, it would take, days or weeks for them to go through all the earning documents from Nvidia and to really find useful things. But here they were able to use AI to quickly go through all the documentation, and they found so many discrepancies and red flags that the conversation on Twitter was just going like crazy, and people were just sharing things they found like where nothing made sense. I'll just give you 3 examples. Nvidia is saying that they're basically running out of GPUs, and it's they have a shortage because everybody's buying, yet their inventory is growing like so fast that it's kind of insane and it doesn't align at all with it. Also, their accounts receivable is growing so fast. Like, it doesn't make sense. Like, they should be collecting the money. And the other thing is, without the accounts receivables, their earnings, which was already a low target because it's constantly revised down, would be a miss. So imagine what it would have been if they missed on earnings. Like, the stock market would be down 10 to 20% the next day. Like, it's just, that important to the stock market right now. And so basically, he said it, I think yesterday or today, that if he didn't beat the revenue, the stock market would have collapsed. So it seems like he has all the incentive to do some creative accounting, and people have really found many ways where they are doing things that completely contradict the whole narrative of the AI bubble and the unlimited demand and all that. So it's pretty bad. Here is just another thing mentioning that the type of accounts receivable jump by 50% in 2 years. There was also a delay, so they have trouble getting the money from their clients and from their biggest clients. It really doesn't look good, and this is the type of thing that Nortel and Cisco did in the 2000, leading to the dot-com bubbles. That's pretty bad. Of course, Michael Burry contributed to the whole discussion by sharing this famous picture that was done by Bloomberg to show all the circular financing that's borderline fraudulent, and it will probably be used to sue many companies listed here in the coming months and years once the bubble completely collapses. But yeah, it's getting there in terms of unraveling in front of people who were kind of willingly ignorant of what was going on. OpenAI has been, looking for money everywhere, pledging money, pretending like they have money. And yet, even their CEO, Sam Altman, is saying that basically Google is getting in their way. And as I mentioned before, not only is Google getting a better model, but a cheaper model, and they are using their own chip. So they have basically the whole integration, plus they have access to so many customers that are using their other products. So it seems like it's really looking bad for OpenAI. And remember, they cannot all exist in a few years. They cannot all be winners. Most of them will fail, just like in the dot-com era. So I really think it's not looking good for OpenAI. Also related to OpenAI, so Michael Burry asked if people could find the Auditor, and this is the webpage of the Auditor, which, believe it or not, was the same Auditor as Cisco after the dot-com bubble. Yeah. And for people who bought Cisco, and most people bought it at the top here because that's when the FOMO gets at the most. It took them 25 years. They just got back to even in terms of the price they paid for the few people who actually hold it for 25 years. But you can imagine that with the inflation, they are nowhere near getting their purchasing power, and they might never do. Just something to show you the damage that the bubble can do when it collapses. And so right now, the people buying Nvidia are probably likely the same people who bought Cisco at the top of the bubble. And something major, I think, that also just happened today. So basically, I was trying to make the video all day, and then they were just, news after news after news, completely changing the stock market in one direction or the other. The Fed and the government trying to pump back the bubble to close green today to avoid people over the weekend stressing and be ready to sell at the open on Monday, which might still happen. But anyway, so basically, he shared that Trump is considering allowing Nvidia to sell the H200 chips to China because right now it's forbidden. And basically here he's saying that this could be a huge deal. And I think I usually agree with most of the stuff he says, but here I completely disagree because yes, the official narrative is that they have a 0% market share in China, but the truth is many people have proven that they are actually selling a ton of chips, by routing them to other countries and stuff like that. And so right now, if people take this as a bullish news and price in major growth for Nvidia because they suddenly have access to the second largest market in the world, like this is going to be the epic collapse when people realize that it's not real. It might take another quarter of earnings for people to realize it. We'll see. And this is just to show you the insanity quickly of the impact on the stock market, not just of the AI bubble, but also the Fed I will talk about next. You can see on Wednesday, it started by going up a little bit and then it just crashed for until noon. And then, of course, it went back up like crazy. So you had that day where, if you were looking at the stock market at a different time of day, you would be like, what's going on? Like it was up by a lot, then it's down by a lot, and up by a lot. Like what's going on? There were so many news too. It was a really big day. And this week has been really like a crazy day on Wednesday, then a lot of panic on Thursday, and then today, a little bit of panic and a lot of FOMO and people trying to prop up the stock market so it doesn't collapse. I'm going to talk about the risky operation now that the Fed has been doing and the complete pivot they did. In case you're not aware, Wednesdays, before the earnings of Nvidia, there were also the Fed minutes that were released, as well as information from the Bureau of Labor Statistics about not publishing the CPI and the jobs data for October, November, might not do October at all, before the FOMC. So basically, the FOMC on December 10th, they will not have access to information for the past 2 months. And the only information they have right now is the unrevised data from September, which will be revised down for sure. They just revised down the previous 2 months into negative numbers. So right now, they are really in the fog if they're looking at the official data. And then the minutes said that, contrary to what Powell said during the conference, they are actually worried about the AI bubble, and they are worried about the high level of corporate borrowing. There are a lot of things that kind of made the market not really reassured by the Fed, not reassured by the earnings of Nvidia. So the chances of a rate cut completely flipped. Started a week about 50-50, and then yesterday it was completely flipped. After all this bad news, basically they said 70% chance of no cuts. And then today, after all the intervention, they completely flipped, and now it's 70% chance of a cut. Powell here has been in the media, I think on Wednesday, and he said two things that also kind of scared the people who paid attention. First thing, he said that the labor market is at stall speed. So that's a really big departure from the strong and resilient job market that they've been talking about for the past year. Stall speed, for people who don't know, it's when the plane is slowing down so much that it shakes and then go down. It can pick up if there's enough altitude to go back up. I know I'm a pilot, but basically it's really bad in terms of describing the labor market, because it's basically saying the labor market is at the edge of a cliff. The other thing he said that was really surprising is that the consumer sentiment is the thing you typically see heading into a recession. So he's not saying before recession or, could lead to a recession. He said it's heading into a recession. I think it's been in a recession since 2022, just being masked by all the AI bubble. But yeah, for the first time, the Fed has been kind of saying, okay, something big is going on. So that kind of spooked the market. Today, he came back to save the market by saying, oh, we will likely cut. And so the market was finally, oh, okay, we're back to bad news being good news, because they don't realize that cutting is actually bad. When you have to cut, it's not a good thing. They just think it's going to be like 2020 when the Fed cut rate and the stock market rate, but it wasn't because of the cut. It was because of all the government stimulus. It just happened to be at the same time. This shows you how the Fed has completely flipped from no cuts and the economy is fine, the labor market is fine. We need to save the stock market because that's the only thing holding the economy together. Now let's talk about the potential black swan. Japan is having some issues. They are the most indebted country in the world. The US is the second one. The problem with having a lot of debt is that when the interest rate on your debt goes up very quickly, that can be big trouble, because then you can no longer afford to pay, and then you have to devalue your currency, or you have to raise rates to combat the inflation that kind of goes with devaluing the currency. People have been using the yen carriage rate for decades, from what I understand, and it's been basically the infinite money glitch, because they can borrow at almost zero in a currency that keeps being devalued. But the thing is about to flip. And there was one time in August 2024 where the stock market in the US dropped by 5% in one day because of this. In Japan, from what I remember, it dropped between 20 and 25% in one day. That was like massive. Once the interest rate goes up in Japan, a lot of people have a margin call. And the other thing is that the assets everywhere in the world that I bought with Japanese yen will be sold massively to pay back the loan. So it could crash the stock market everywhere else. So right now, this is one of the things that I'm watching because it could really be the black swan that, you know, breaks everything. And as you can see, this is just the rise of the US dollar yen. So basically, if it goes up, it means the yen is going down in terms of value. And last time it broke around 160. And so as you can see, we are about 2% away from both the central bank of Japan and the government having to intervene to save the market to prevent a total collapse, basically. The impact is real because here it shows you that the people who hold bonds in Japan since 2020 have lost about 48% in terms of their portfolio. And so that's why since 2020, I've not had bonds other than, a few technical trades for a few weeks or a few months, because I don't believe in them long term, because I believe that after 40 years of disinflation, we're now into an inflationary cycle. Of course, there will be up and downs. We might even have a small period of actual deflation, which will probably freak out all the central banks and government. And so they will massively print, which will lead to massive inflation. But yeah, basically bonds, they're basically screwed if the interest rates on long-term bonds rises, which is what is going to happen if there's uncertainty, because there's always a risk premium, and there is inflation, and there's growth. And the growth doesn't have to be real; it can be just manufactured by printing all those liquidity, just like the AI bubble. So basically, the three components that would make a bond perform well are against it, probably for the next few decades. So that's why I'm not touching bonds, and most people are risking a lot for very little return. That's just my opinion. Now let's talk briefly about Bitcoin, gold, and silver. For gold and silver, I'll show you the live charts. I was expecting a drop potentially to about K, but I was not expecting the drop to be so quick. And also, I mentioned that it could go down as low as 75 to 80K at the lowest, but I was expecting this to take a few more weeks or months. I was really surprised at the speed of the drop. The good news is that I think almost everyone who wanted to sell has sold. And so that's why we see levels that are typically seen at the lowest of a bear market. And right now, it's a medium risk, high reward potential, at least to catch a rebound, but potentially a new all-time high in the next few weeks or months, especially if the government central bank are really trying to save the stock market. All the charts I've been seeing recently are showing the same thing. The asymmetry in terms of risk reward is excellent right now. And this is why I'm using options, because I can bet a very small amount. And so if I'm wrong, I don't lose much. And if I'm right, I can make 10x, 20x what I'm putting in it. That's why it's really good time in my perspective. Also, remember, people were jumping into Bitcoin and all the assets after the April sell-off. And right now, people are putting even more money than they did during the April bounce. So if just with this amount of money, we're able to get Bitcoin from 75K to 126, imagine what a rebound here could make it, especially because of all the shorts. So many people are betting against Bitcoin right now that there could be a short squeeze. All the people who bet against Bitcoin, they have to buy Bitcoin if the price goes up. Otherwise, they could lose an unlimited amount of money. And so this really can fuel the rise, because as sellers sell to avoid losing money, other sellers need to sell. And basically, the price of Bitcoin could be 20K higher within a week or two if there's a short squeeze. Based on my analysis, I think that we'll get a bounce to at least 100,000, potentially 110 in the short term. And then if there's really some bullish narrative from government and central banks, it could go back up to 130 and potentially higher, because they can be always the euphoric top that we haven't had this bull run. So we'll see how it goes, but just something that I wanted to mention, because the risk reward has never been this good in the past 3 years. So also, very quickly, the crash of Bitcoin since the all-time high on October 6th has been about the same length and speed as the 2020 Bitcoin crash. So I find it interesting when you think about what happened next. All right, so now let's talk about gold and silver. So here I have the chart of gold. If you've been watching my previous video, you remember that I talked about the period of consolidation we had here, then the big move. Here I told you that we were likely due for a drop. We dropped at the level I think that was going to hold. And I told you that if the stock market dropped, gold could drop as well, not because it's bad. It's just because when people panic, either they sell everything, or some people get margin calls and they have to sell the good assets to pay for the losses on the other assets they have. So gold could technically go down to 3750 or even 3500 if there's a really big crash. But right now, my base case is really for this to coil here for maybe a few more days or a few more weeks, and then take off again and be higher by the end of the year. I don't know how high. I don't think it will be as massive of a move, but I'm expecting gold and silver to continue because the fundamental and the technical are still good. Also, something not worth noting is that during this the past few days of the crash, you can see that gold has actually held the 50% level on the Fibonacci. So that's really good when you knew, if you know what I'm talking about, because basically it means that during the sell-off, they didn't sell off massively. It was really good at holding on the support of the last impulse to go higher. And it's basically the same thing for silver. Yeah, as you can see, so we had the euphoric top, the pullback I called. Then we went back up, new at all-time high, and then it's been pulling back, but again with support around the 50% level. So that's pretty good. So I think it might go sideways a little bit more, but eventually I'm really certain that silver has all the potential to really go a lot from here, even more than gold, because it has a lot of catching up to do. And for the past few years, there's been, contrary to Nvidia GPUs, a lot more demand than supply. And so there's a supply deficit for silver around the world for the past few years. And so at some point, the price has to reflect it. So that's something I'll be watching. And just briefly for SPY while I'm on the charts. So as you can see, this was the close before the earnings for Nvidia. This is the FOMO I was talking about on the Thursday morning. And this is where I'm shorts because I saw the FOMO charts that I'm using, the indicators going off the charts literally. So I knew it was going to drop, and then we had the massive drop. So you can see during the day, it really went in several waves, but still ended the day much lower than it closed the day before. And then today, there was initially went down, and then there was some news from the Fed about the flipping, and you can see there was a big bounce, and then it started to go down again. And then that's when Trump came out with the Nvidia might be able to sell chips to China, and it went back up again. But then at the end, there was a bit more selling because the uncertainty remains. But so look, this is where it closed before the earnings. And 2 days later, it's slightly lower, but almost finished at the same level. So it was kind of insane 2 days with a lot of FOMO, a lot of panic, and then a bit of FOMO going back up here. But as you can see, it's kind of measured. And so that's why I think a lot of people are going to think about their investment portfolio this weekend and what they will do on Monday. So here's the bottom line. The AI narrative is really hitting a wall. The reality cannot be put aside anymore. And the Fed trying to prevent the disorderly collapse before the holiday is likely not going to work. They really need the government intervention to do it, just like in the March 2020. But it's only a band-aid on a broken leg. It's not going to fix the whole thing. And with the economy stalling and the smart money pulling back for the past few weeks, I've been telling you about the topping process and how the institutional have been selling to retail. This is not looking good. And so I'm expecting the topping process to continue and for a big drop to be the base case before a rebound. And then based on what will happen, we'll see where it goes. And so if you felt the urge to panic sell yesterday or chase the market today, you are reacting to noise and you're reacting to your emotions, and you're not following a plan. And this is the worst possible thing you can do, because that's how people buy at the top and sell at the bottom. And so if you haven't done already, I really encourage you to watch my free masterclass. It really teaches you how I manage my portfolio and basically how you can protect your portfolio, because it's the equivalent of driving a car with brakes and airbags, which most people, unfortunately, are investing without any protection. It doesn't mean I want you to go with me. I just want you to be aware that they exist and that you can potentially use them if you take a little bit of time to learn how they can be used. It's really easier than it sounds. So I really encourage you to do this. So click on the link below. It could really save your portfolio. If you have any questions, feel free to leave it in the comment. I'll do my best to reply. And stay safe, invest smart, and I'll see you on the next one.